I'm Michael Fox, and this is the Prospector News Podcast. And I am on location at the New Orleans Investment Conference in Louisiana. And as a nice treat, I have sitting right across from me in live in person instead of over the computer, the national investor, Chris Temple. Welcome, Chris.
Hey, good to see you again.
It is absolutely. It's nice to be in the same room at the same time sometimes, isn't it?
Yeah, for sure. This is better. We're social animals, and technology is nice, and doing things from a distance is nice. But every now and then, it's nice to get together and break bread and share a cocktail and share thoughts and whatnot live and in person.
Yes, no, absolutely, definitely. And it was good to catch up with others here at the conference, clients, friends, analysts,
Yep.
and get their take on the world as it is today. And you and I had a nice cocktail on the first day, and we got caught up on our views. And the Fed came out and did exactly what you said they were going to do, and that was pretty much nothing.
Well, it was, Mike, but the one maybe minor qualifier to that is that in September, there was a decidedly hawkish pause on the part of the Fed, as we talked about after the fact back then. They took away 2 of 4 potential rate cuts for 2024. That reinforced the idea that the high level of interest rates is going to hang around for quite a lot longer than anybody thought. And that, of course, caused some hiccups in the market at the time. On the surface, we didn't get anything different than that. And of course, we're not going to get a new dot plot until the December meeting. So we didn't have that to go on this week. We don't know how that's going to change or not. Some of the economic numbers have softened a bit more for the Fed. So I think for them, they think that's a good thing. But I think what changed just a little bit in the tone of Fire Marshal Jay this week was that it seemed almost as if he had 2 different wings. If you look at him, one wing certainly did look like that of a hawk, but the other one was a little bit wider, a little bit sleeker, and you wonder if that was a dovish wing. And so now he's a hawk dove, or some kind of a hybrid.
I just all I know about that is I don't want to be walking underneath one of those.
No, you don't. No, and especially when you hear what comes out of his mouth at a lot of these meetings, because then there'd be a lot of that falling on you.
Yeah, no doubt. It's really interesting. And then, as I say, the data and stuff, and even some of the Fed speak makes you kind of wonder what direction they're really going to go in, because one of the things that I picked up on in some of the commentary afterwards was he had indicated that he was happy to let the bond market do the heavy lifting for him, meaning that the bond market was taking care of the interest rate hikes, so they didn't have to. But immediately after that, the 10-year bond markets came off of that 5% mark that they were sitting at, and it slid back to closing close to 4.5% by the end of the week. So is the bond market itself daring the Fed to raise interest rates again, or are they just out of touch with what's happened, or am I reading it wrong, Chris?
Well, maybe somewhat it's the latter of those, I must say. And here's my take, Mike. After the September meeting, when the Fed, and everybody knew going into September meeting, they were going to pause. There was never a question about that. But it turned out to be a hawkish view, because they took 2 of the 4 rate hikes off the table for 2024, as I said, as far as their dot plot and game plan and whatnot. Still kept a potential of an additional rate hike on the table for this year, still, which is probably now gone, but that remains to be seen. Now, typically, when the Fed, when you wrap it all up, does something that's hawkish and suggests they're going to be tougher, even if that doesn't mean new rate hikes. Don't forget, they're still rolling off the balance sheet and all the rest of this. You should have seen long-term rates go down after the September meeting. That's what should have happened, because that is when the market smells that the Fed is going to be too tight in the end, going to cause a recession. And typically when that happens, that's why the long end interest rates come down, because people are buying those long-term bonds, betting that the Fed is going to bring about a recession, et cetera. But they did go the opposite direction. We raced from 4.4% or whatever the 10-year was until up to that time, and we tickled 5% a couple, 3 times in the last week and a half or whatever it's been. So to me, I think we need to start looking at a lot of different things, not through the lens and with the formulas that we used during the 40-year period of overall disinflation from the early 80s to a couple, 3 years ago. We need to look at things through the bond market's eyes and realize that bond yields now, and yes, you're going to have aberrations one way or the other. You had a big spike in yields and then a knee-jerk reaction the last half of this week where yields came right back down and gave back that 50 basis points that they went up after the September meeting. And let's figure out why yields are going to do what they're going to do going forward. I think that this is a little bit of muscle memory where people just, because the market had got skewed one way too much, they brought rates down. But if you remove, Mike, that spike from 4.5% to 5% and then right back down following the September Fed meeting, we're still in an upward trajectory for long-term yields. And one of the things people need to get, I think, through their heads is that going forward, the market is going to start working much more as a market with treasury yields. We've listened to a few good speakers here on this subject. And let's not lose sight of the fact that with the gargantuan volume of issuance for treasury securities that's upcoming, $2 trillion deficit when we've allegedly still had a good economy. It's going to double in the next 2 years if we go into any kind of a deep recession, all else being equal. In the next 3 years, half of all the outstanding government paper is going to come due. So the Treasury is going to have the same problem that commercial real estate and a lot of other private players in the economy have now as they're having to roll over some debt at higher yields. We're going to see a lot of things hit a wall. And people want to believe, which is why you had that bond rally this week, that, you know, it's going to be safe to go long treasuries again. And I don't think that that's a good bet because there's just so much of it that's got to be funded. I think you can have a scenario, and this is part of the stagflation scenario that we've talked about before, where you can have a weakening economy, but you're not going to see long-term yields at least tumble down, even if the Fed starts reducing short-term yields. In fact, I'll predict that if in the next year or two, the Fed starts lowering short-term yields, you're going to see the long end respond even more because they're going to be dealing with inflation and supply, both of which will keep that upward pressure in the market.
Yeah, I could see that definitely as an option here going forward. But you know, I look at the bond market that says one thing, and then the stock market's like the Fed turned around and reloaded up the punch bowl and said, "Have at her again, boys."
Well, there again, the stock market, I think, had been, it had been declining almost for the whole time since the last Fed meeting. And you already had a bit of a rally brewing, and they seized on this half hawkish and half dovish, or 2/3 hawkish and 1/3, whatever you want to call it this week. Less bad, I think, than the September meeting. And so that was just an excuse to take a market that was still oversold and have everything rip higher the last few days. I don't believe it's going to last, though.
I don't either. Like, it's, both animals seem to move in a counterintuitive way to my thoughts on the process. I looked at it and went, the market should have been down and the bond should have been up, and I got I got bizarro where everything was backwards.
Yeah.
But I'm getting used to the markets being dyslexic and going in the opposite direction of what I think they are. So it's, it is what it is. Jobs markets were not particularly good. They rebalanced September downward again. The October jobless numbers were lackluster before, in the initial, and if they rebalance downward like they have for the last several issues, that's signs of a slowing economy.
Well, I'll give you another sign of a slowing economy, and that was the latter part of this past week when the CEO of Target, one of the major retailers, came out, and among his observations was that shoppers in Target stores are even starting to be careful with their purchases of groceries in the Target stores that carry groceries. But these days, I think that's most of them. So, but we've already got and you and I were discussing this off mic and with some of our friends here, during this New Orleans Investment Conference as well. You've already got a situation where the first phase of a recession is already very evident, with a lot of people that are, barely middle class rating, let alone, need some government help or have to work 3 jobs and then make choices over what they're going to spend money on. Those type of people, which is a big swath of this country, are already feeling this because of between Jerome Powell. I mean, yeah, a lot of people for partisan reasons call it Bidenflation, but it was Powellflation before it was Bidenflation. Because Jerome Powell was the single biggest proximate cause and originator of the inflation that Joe Biden did indeed make worse, but he didn't start that. So you've already got that. I think that as the next 1 or 2 quarters play out, you're going to see, and you may remember that when we talked about this before, I predicted that after one big last hurrah for even the consumers who could afford it, to take their summer travel, brisk demand for gasoline, brisk demand for airplane tickets and everything like that this summer. The last of the COVID delays, big vacations have been taken, and now it's going to become hunker down time, even for more affluent consumers. So it's not like the world's going to end. There's still a lot of liquidity. There's still a lot of discretionary income from the higher income groups, but you're going to see a lot more notable and broadening downturn for the economy going into early next year. And, let's not forget that, and we've been told this consistently. I mean, you can fault Jerome Powell for an awful lot of things. And as I said, Mike, most of all, being the initial cause of the inflation that he's now trying to clean up. But the one thing you can't fault him on for the last year and a half or so now is his messaging. He has been very consistent that it's going to take some pain. It's going to take subpar growth. It's going to take higher unemployment. It's going to take less consumption for them to finish the job that they think they can do. That's a different story, whether they'll achieve it, of bringing inflation sustainably back down to 2%. So whereas you had some cheering going on in the last few trading days this last week from people saying, oh, goody, the Fed's going to start slashing rates because there's a little bit of pain. Oh, no. Powell told you he wants that pain and he wants more of it. So don't think that a few weaker numbers that still we're still above trend growth for the economy. When you look at the raw numbers, he's going to want a lot more of this.
Oh, yeah.
And or some market debacle, which may come or may not come, but he's not going to flinch now and start cutting interest rates for sure, even if the odds are tilted toward they're going to not raise short-term rates anymore.
Yeah, well, I'm looking at it, and you and I have had this conversation. Actually, we had it over those cocktails we talked about earlier. We're actually, I think, in a two-step recession. I think we're in recession for those people in those lower incomes that are having a struggle keeping the roof over their head and food on their table, but it hasn't reached the wine sipping latte guzzling crowd yet.
No.
Where they're not having to make the decision, okay, well, I'm going to cut back on the number of lattes or glasses of wine that I'm going to have. And I think that until the recessionary pressures start to cause a bite into that part of the economy, I don't think that Powell's going to blink at all. I'm contrary to what you say. I think there's another quarter point coming in December.
There could be. We'll see what happens with the inflation numbers between now and then. The Fed, and another subtle change in this last week was where at least some of the Fed members were thinking it was a good thing that the economy didn't slow down as much after all these rate hikes and so forth. But again, I think that the underlying and main tone of the Fed is that they do want to see weaker growth. They do want to see all these other things that bring inflation down. But, I was talking to a colleague here, in fact, Jim Urio, name a lot of people know. And among other things, besides being one of the smarter economic commentators out there, Jim owns a very nice restaurant up in the Chicagoland area. And so one of the questions was, I asked him how the restaurant's doing these days. And he even made the observation that since the end of the summer that they have noticed, and it's subtle, but they have noticed that people are a little less exuberant. And actually, your comment is informative here, Mike, because he did say that he's starting to see some people who will leave and pay the check, maybe without having that last drink before they go out the door, maybe without spending quite as much time and money there. So I really do believe that we are going to see, and it's going to come about, I think, faster at last than how we've seen things evolve to this point. But by next year, you're going to see some more substantial hits to retail sales. I think car prices, notwithstanding the upward pressure because of the strikes and the labor issues recently and these wage concessions the automakers have had to make, that's going to really crimp car sales. I think you're going to see some softening there. You'll see softening in a lot of discretionary things, but unfortunately, the stuff that everybody needs to spend money on, like it or not, food, clothing, shelter, utilities and whatnot, those things are going to continue to have upward pressure on their prices for a variety of reasons. So it's going to be a nastier, more entrenched great stagflation.
Yeah, no, I agree. I'm starting to wonder openly, we're here, it's November the 3rd. We're chatting here. We're 3 weeks away from US Thanksgiving.
Yep.
And that's traditionally the start of the Christmas shopping season. And I'm wondering, what those Black Friday numbers are actually going to look like this year. Is the inflation going to take the allure of bargains out of the equation, and are those numbers going to come in a lot worse than what we think? Or are we going to have Christmas 2023 as be the last hurrah before the inflationary bite really stakes in, grabs a hold of you?
Hard to say. I think that it's going to be a disappointing time. The usual game playing on the part of corporate America of managing expectations. I put that in quote, managing expectations, end quote. And this idea that, 70% of the S&P 500 beat estimates. Well, who cares what the estimate is? How do your earnings compare to last year? If it was estimated they were going to drop 5%, but only drop 4%, are we supposed to dance in the streets and pop champagne corks? Okay. And there's going to be a lot more of that going forward. I think as we get into the fourth quarter, there's already talk that a lot of companies are trimming their earnings estimates for the fourth quarter, their own forecasts. So I think that in answer to your question, we are going to see some pretty notable weakness in this upcoming Christmas season, and it's going to worsen as we get into 2024.
Yeah, and it's also the other indicator that occurs at that period of time is holiday travel. It's a big 4-day weekend. A lot of people head home for the turkey dinners. It's one of the busiest air travel weekends. Yep. Between those two indicators, I think we're going to have an idea if the party's actually over.
Well, I can tell you this. I was just looking yesterday at airfare from Florida up to New York, which I may do at Thanksgiving time with my wife. And that's up in the air over some family things right now. But I was rather surprised to see round trip from Orlando to Syracuse was $160 on 3 different airlines. And this is just one example, but I have heard other anecdotes about how after having gotten all they can get up through summer with everybody, money is no object when it came to the last hurrah of summer travel, that I think we're going to see things like that start to hit a wall again. And I do believe that whatever is not necessary, I mean, in short, Mike, people are going to distinguish between needs and wants. And it's not going to shock me if we get into early next year and you're seeing stories about travel falling off again, washer dryers, new refrigerators, new cars and whatnot. They're not going to be moving quite as fast. It's going to soften their prices. But again, the staples are going to continue to go up.
Well, that's true. But at the same time, and this is where we get into the stagflation argument, with the supply chains being what they are right now, you go to a store and you look at the what's on the shelves, and there's a lot less on the shelves than there used to be because they simply can't get the products in to sell them. Is that going to continue to put inflationary pressures on a bad economy, and we get into the full-blown 70 stagflation problem?
Well, we are going to see some of that. And of course, especially at a conference like this, which is mostly resource stocks and things like that, extractive industries, real assets, whatever you want, whatever term you want to use. This is one of the parts of the puzzle that I think the average investor is still completely asleep on. I think the economists and prognosticators are completely asleep. And that is, to your point, Mike, that commodity prices across the board from here on forward are going to be driven by things that we aren't used to for the last generation. For the last generation or so, the main drivers of commodity prices were, number one, you had a weaker US dollar. If you had periods of a weak US dollar, everybody would say, okay, that's good for commodity prices, all else being equal, because that means that the commodities will go up in value in dollar terms. And the other thing being that you want to see at least a halfway healthy, if not robust, economic growth picture so that the demand would stay up. But the driver going forward is going to be neither of those, as much as it's going to be the acute structural lack of supply of commodities. And I don't care if you're talking about uranium, copper, crude oil, natural gas, whatever. All of these things, to one extent or another, are subjects for years of underdevelopment. In the case of fossil fuels, policy impediments, very acutely. Don't forget, folks, that the reason, if you're a US citizen like I am, don't ever lose sight of the fact or forget that the reason why Janet Yellen got her job in the first place as Treasury Secretary was because she was going to use her job as Treasury Secretary to beat the fossil fuel industry into submission and put them out of business by curtailing credit and so forth. Now, they don't want you to remember that anymore, but that's why she got her job. And she was a founding member before that of this big global green energy, green movement think tank. So whether it's that, whether it's all these other things, and that's where the equation for inflation is going to thwart anything the Fed can try and do to bring it back to 2%. Because you're going to have a scenario where you're going to have high gasoline prices, high heating prices, and things like that, even when the economy goes into recession. Nobody is contemplating that possibility, just like they're not contemplating the possibility that even when we go into recession, long-term yields will not come down that much and may go up more.
Yeah, well, and we just had some interesting things happen in the auto industry. The unions settled, and they settled for some pretty big wage gains. And I have to sit there and wonder, okay, yeah, you got the wage gains, but if no one's buying cars because they're too expensive, how long are you going to keep the job with those higher wages?
Well, you'll look, we're already back, and that's a perfect example of it. Jerome Powell, for a long time said inflation was transitory. We all know that wasn't true. And what he said since then, even after admitting that inflation really isn't transitory after all, he has insisted that he sees no evidence of a 1970s style wage push inflation. But we've already got that entrenched. Well, what happened after the 1970s wage push inflation? You had a recession, you had layoffs. All right. And so, yeah, you will see a point where the automakers, they're not going to be able to take those wage concessions back right away. So they'll start laying people off when sales soften. If it gets real bad, they'll go back to the unions and say, hey, we both overshot the runway. If you want to keep more of your people employed, you're going to have to give some of this back because we can't afford it.
Yeah.
So there will probably be that down the road in a couple of years.
Yeah, just a couple of years.
Maybe sooner.
Those were pretty historic wage increases.
They were.
The pilots have gotten the same, UPS workers, FedEx workers. These, and what concerns me on these, not that these workers don't deserve more, but what concerns me is that these are key factors: transportation, energy, wage input, that are inflationary pushes. And I think we're delusional to think that when we're in an environment when all of those items are going up, that the Fed's monetary policy is going to have any effect on inflation whatsoever.
Well, it can't. I mean, the Fed can do certain things with monetary policy. But the Fed does not have the policy authority or ability, for example, to say, okay, we're going to completely revamp and streamline permitting because we are critically short of copper and lithium and cobalt and graphite. We've got a lot of that within our own four walls, and let's mine that. And if we do that and increase the supply of those things, that will bring down the price of those things. That's the irony, and it's kind of, it's almost comical when you look at President Biden and what was passed early in his term that was ended up called the Inflation Reduction Act. And everybody ridiculed, everybody made fun of it. And, it's, of course, when it comes to, I don't care if you're a Republican or Democrat, you always make something sound good, the motherhood and apple pie resolution, or the baseball and hot dogs measure, or whatever you want.
Can I sign up for that one?
Yeah, sign up for that. But the irony is that if the same Biden administration would not now be continuing to hinder the development of the resources that we need in this country, it's not completely a bad story. Yes, there are a handful of instances where Defense Production Act money, Export-Import Bank now, and some other things are helping some companies in America further projects that are critical to our economy and to our getting off of foreign sources. But what has been done is very, very, very minor in the grand scheme of things. And if we didn't have that, the Inflation Reduction Act, if it enabled all of these things to be mined and produced in this country that we need, would actually, believe it or not, all else being equal, have work to bring inflation down or keep it at least less bad. Because if we need X amount of copper, and we all know we're short of copper, and you mine more of it, the price won't be as high.
Yeah,
That's
no,
not
absolutely.
rocket science.
Yeah, the cure for higher prices are higher prices.
Yeah.
But the thing that is probably floated under a lot of people's radar, and mine included until the last couple of days, the Biden administration has signed a deal with Indonesia to buy nickel.
Right.
And there's another instance where they're going to an unfriendly country simply because they're not willing to produce it in their own backyard. And we all know about the nickel plays in Minnesota that are being held up by government issues.
Well, and you've got other nickel plays in North America, but the U.S. and Canada both. Indonesia, don't forget, and you can look this up, folks. A lot of people have written about it. I've talked about it. It's very, very dirty. The environmental the detrimental environmental footprint for the nature of the rock that nickel comes out of in Indonesia and the lack of environmental safeguards. It's way worse for the environment than it is if we did it here with American workers, first world wages, first world environmental protections. But this is far from the first time that the Biden administration has demonstrated its idiocy and hypocrisy, both by, flipping the bird, such as it is, to U.S. industries and resources and workers. And for as long as it can get away with it, getting these dirty sources of raw materials from other countries, and really an exploitive way too.
Yeah, like I sat on the outside of a panel discussing ESG in London last December, and there are times where I'm kind of I'm a little bit flippant at times in these scenarios, but I'm generally end up being right, and I hate being right in these situations. But one of the flippant remarks that I had made at the ESG was that if push comes to shove and there's a shortage of cobalt, and I was using cobalt as the example, they weren't going to care that there was child labor in the Congo providing the cobalt. They needed it. And lo and behold, 2 weeks later, the Biden administration is buying cobalt from the Congo. And the same remark was made about Indonesian nickel. They don't care that they're a big polluter. They just need the nickel. And well, here we are a few months later, and Biden's made me look like a genius a second time.
Well, on that first one, Mike, I got some people upset with me earlier this year after that deal with the Congo, where I had my cartoonist show Joe Biden dressed up as a Southern plantation owner, cracking a whip, standing on a bank up above this parade of Congolese youth that are coming up carrying all of this mud-laden dirt and rock and stuff on their heads and on their shoulders to mine his cobalt. Joe Biden, the absentee owner of this plantation in the Congo, who says white supremacy is a terrible thing in America. But if it's him and he's the de facto absentee owner of cobalt projects in the Congo, so that he can placate his environmentalist friends in the US by not allowing it to be done here, which there's a lot of cobalt in the Iron Range of Minnesota and elsewhere, then hey, let's call a spade a spade.
Well, I will call a spade because in the Congo, it's actual at gunpoint slave labor of children. And and when there's other supplies in North America in your own backyard, why are you promoting that kind of environment for something you wouldn't want for your own kids?
Well, it's the same reason that many years ago, manufacturers of all kinds outsourced labor to third world countries, to developing nations, first China, then some other Asian nations, some African nations and so forth, because it's all about money. You have no patriots in corporate boardrooms by and large. It's all about the bottom line. And whether it's Biden with his hypocritical and racist and exploitive move with the Congo over cobalt, whether it was years ago as clothing manufacturers fired Americans and hired people elsewhere that made sneakers and t-shirts and whatnot more less expensively. All of them are driven by profit motive. They have no patriotism. They have no regard for their people they employ. To them, people are just a cost of doing business, and they want the lowest cost that they can get.
Well, that's true. The last question I wanted to ask you before we start to wind this up was, if you remember the 1970s, what precipitated the energy crisis was the Saudis cutting off oil exports, or OPEC rather, cutting off oil exports to the United States. As we're moving into a bilateral world with the BRICS versus the West, is there a commodity that could possibly get cut off by BRICS nations that would precipitate a crisis?
Well, when it comes to crude oil, one of the problems that the U.S. has, even though on the surface we produce recently 13 million barrels a day, just about at the all-time high level, which I think is where it's going to peak. We're going to see it fall off some next year for different reasons we can talk about on a different conversation. But the problem is that we need a lot of heavy oil. We don't import enough of it from Canada. President Biden wants now to loosen sanctions on Venezuela if they agree to some political reforms so that we can start getting Venezuelan oil again. I, for one, am in favor of that. I think that a lot of our oppressive sanctions, whether it's Venezuela or Cuba, which is idiotic all these years after the Cold War and all that, none of that should exist. So I would love to see Venezuela, for the benefit of its people, producing and exporting more oil. That'll help everybody. So that's not the big issue. To me, you've got rare earth elements, which China controls the lion's share of. They just recently announced, though we don't have the details yet, that there are going to be export curbs on graphite.
Yep.
Without that, we have no EV industry for Joe Biden and his environmentalist friends. There was a shot across the bow from Russia's main nuclear energy company and exporter, Rosatom, about a month ago, where out of nowhere there was a news story that broke, that a number of people circulated that they were going to stop selling enriched uranium to the U.S. We have no enriched uranium capabilities yet, again, in this country. Once upon a time, right after the Second World War, we had a fresh, modern, clean nuclear energy industry where we were able to control and build every part of it from start to finish. We gave up the majority of that. So now we have very little uranium mined, though that's finally going to be turning around in this country. And we don't have any enrichment capability that could immediately replace what Russia sells us still right now. So that would be a major headache, to be sure. You know, the graphite thing, and there's others, rare earth elements. We need these things for military, for technological, for security, for electronic infrastructure applications, all these different kind of things. So, you know, we last year, Mike, in 2022, we saw the first episode of what will be a multi-episode and multi-commodity episode, new energy crisis that we're going to have with us for many years. Last year, it took the form of record high gasoline prices and the big spurt that we had in natural gas prices. Those have both eased. Natural gas cheaply because there was an aberrationally mild winter in both this hemisphere and in Europe last year. Even if we go back to a normal winter this year, that cushion will be gone for the most part. We're going to have higher prices, therefore, for natural gas again to come. We've had all of the impediments to further development of these and other resources. So, you know, we're going to have this tag team energy crisis where we're going to have a shortage of this. We'll have exports of such and such a thing cut off. And again, I don't think people, as I alluded to earlier, are prepared for the reality that even if we do slip into recession, prices of all this stuff are going to stay high.
Yeah, no, I agree. It's, you know, I remember the 70s as a kid, and I don't remember them fondly. And I'm thinking we're heading back that way. So if people want to follow your musings, Chris, where do they follow you?
Simply go to nationalinvestor.com. Make sure you sign up for my mailing list at the top of the page if you're not already on it, or on social media. I'm all over the place, but mostly on Twitter/X or whatever Elon is calling it this week. And my handle there is @NAT Investor.
Wonderful. It's good to see you in person.
Yeah,
and I guess the next one will be actually down in your backyard in Miami in February.
Yes, sir. I'm actually on the planning team for the Mines and Money, and in the last part of February, you'll be hearing more about that from both Mike and myself, folks. And one of the things we're going to be doing is getting some public policy experts and people even from outside the mining industry who are going to help people to get this driven into their head that the reasons why we have a secular bull market for a lot of these commodities unfolding are not healthy ones. It's not ones driven by a healthy economy, but these are all strategic things. As I've said before, you've heard me say this, we've already got a World War III underway for a while now over currencies and commodities. And we in the US are starting out at a terrible deficit.
No, we're already behind the curve, and we're going to be playing catch up for quite a number of years.
Yep.
Good talking with you, and we'll pick these conversations up in a couple of weeks as we always do.
All right. Take care, Mike.
You bet. The Prospector News Podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.